All right, so we just talked about TAC, which is us purchasing a single asset. What happens when we purchase multiple assets for a single transaction? That's what we're talking about in this video, lump sum purchases. We also call them basket purchases. And what these are these occur when multiple plant assets are purchased in a single transaction. The last video we talked about, what if I just purchased a vehicle? Or what if I just purchased a computer? What happens when you purchase a business? You know, you're going to get the buildings and the vehicles and the machinery and the inventory and all this other stuff that comes with it, but you're going to pay one price for it. But what we have to do is be able to break that price up or that cost and put it into the categories of the asset. So how do we do that? Well, the individual asset cost is determined by allocating the cost of the purchase among the different types of assets acquired based on what we call the relative market value or their appraised value, what they're worth today. Most of the time, what you pay for all this stuff in a lump sum purchase is not going to be what they're appraised for. So I'm going to show you an example how to do this. Let's look at this example. November Company purchased Oscar Company for $2 million. In the purchase, November Company received a building, a land, a truck, and equipment. The appraised value for the building was $1.25 million. The land was $750,000. The truck was $40,000, and the equipment was $360,000. What total cost will be charged to the various asset accounts in the lump sum purchase? So I need to be able to take that $2 million that I purchased all this for and break it up into its four components. So the way I would start doing this would be to start with a table. Okay, I'm going to start with assets. I'm going to list out my assets. I'm going to have building, I'm going to have land, I'm going to have truck, and I'm going to have equipment. Okay, and then from there I'm going to look at the appraised value. Okay. So my appraised value for building was $1.25 million. For the land, it was $750,000. For the truck, it was $40,000, and for the equipment, it was $360,000. What I'm going to do with that is I'm going to divide that by the total amount of the appraised value. That's going to give me a proportion of the appraised value. So if I were to add up the $1.25 million, the $750,000, the $40,000, and the $360,000, which is all these were appraised for, that's going to give me 2.4 million. And so that's what I'm going to divide each of these by, the appraised total. So divide by 2.4, 2.4, 2.4. I could have made this go a little bit quicker, but okay. And when I divide that, that's going to give me a percentage. And that percentage is going to tell me what the appraised percentage is. So for building, it's going to be roughly 52.08%. So what that's telling me is that almost a little over half of the appraised volume is going to, or appraised value is going to go towards the building. So that means almost overall, over half of the purchase value is also going to go to the building. The land is also going to be 31.25%. The truck is going to be 1.67%, and the equipment is going to be 15%. Once I have each of their appraised percentages, I'm going to multiply each of those by the total that I spent on these things, the total cost, or the amount paid. So multiply this by 2 million for each of them. Again, I could have done this a little bit quicker, but you know, accounting is not for quickness. Multiply that. That's going to give me my total asset cost for each of these. So I'll multiply 52.08 times the 2 million. That's going to give me 1,041,600. Land is going to give me 625,000. Truck is going to give me 33.4. And then finally, equipment is going to give me 300,000. If I were to add all of those up, my total asset cost, that will give me the 2 million that I originally paid for. That is how you do a lump sum purchase.